So Exxon Mobil is currently in, well, basically a 10% free fall right now in April 2026. And this is right on the heels of a massive 41% surge. So if you're looking at your portfolio today, you have to be asking yourself a pretty critical question. I mean, is this stock flashing massive, undeniable sell signals, or is it a deeply undervalued giant just sitting at a ridiculous discount?
Yeah, it really is the ultimate puzzle in the market today. Because, you have this incredibly robust fundamental business, just a massive cash-generating machine, but it's clashing directly with some really ugly, fearful market momentum.
Right. And today, we're putting Exxon under the microscope. Welcome to the Deep Dives, everyone. We are going to dissect these conflicting signals, unpack those rock-solid financials, and contrast them against a technical chart that is, frankly, bleeding right now. We need to figure out if this is a classic value play or, a classic value trap. But before we dive into all the data, please do us a huge favor. Hit the like button, subscribe to our YouTube channel so you don't miss future deep dives, and definitely drop your feedback in the comments. We really want to know where you stand on this debate.
Absolutely. And just to set the ground rules before we get into the weeds here, what we're doing today is a natural human debate. We're just two people analyzing the data, weighing the fundamental business against the technical charts. So this is an educational discussion. It is absolutely not financial advice, and we aren't telling anyone what to do with their portfolio.
Exactly. So let's unpack the sheer whiplash we're seeing in the price action right now. Let's just ground ourselves in the data first. As of April 14th, 2026, XOM is trading at $151.40.
Okay, so it's down just under 1% today, right?
Yeah, exactly. But if we zoom out and look at the scope of the year, I mean, the 52-week range is huge. It goes from a low of $101.19 all the way up to an all-time high of $176.41. And the crazy part, it hit that all-time high just a couple of weeks ago on March 30th.
Right, and the velocity of that climb is really what caught so many people off guard.
Yeah. So let's talk about how we actually got to that peak. Because in the first quarter of 2026, the stock rockets up 41%. And the driving narrative there, well, it wasn't a sudden discovery of a new ocean of oil. It was heavily fueled by geopolitical tensions in the Middle East.
Right, yeah.
But immediately after hitting that peak at the end of March, we get this sharp 10% correction here in April. I mean, it feels like the floor just dropped out.
It really does. It's the suddenness of the shift that has people so on edge, definitely.
But I want to push back a little on the panic narrative here, because everyone on Wall Street is calling it a sharp correction. But is a 10% drop really that alarming? I mean, if a stock runs up 41% almost entirely because of geopolitical anxiety, isn't a 10% pullback just completely normal profit taking?
Mm-hmm.
Institutional investors are going to cash in their chips eventually, aren't they?
Yeah, that is a crucial distinction to make. And to understand the mechanics of what's actually happening, we really have to talk about what's called the geopolitical premium.
Okay, break that down for us.
So oil stocks are uniquely positioned in the broader market. They are highly tightly correlated with volatile, sudden oil shocks. When tensions flare up in the Middle East, the market instantly prices in the absolute worst-case scenario for global oil supply. That anxiety literally gets baked into the stock price. So that extra price you're paying above the fundamental value, that is your premium.
Oh, I see. So to be clear, that 41% run-up wasn't Exxon suddenly pumping 41% more barrels out of the ground. It was basically the market mathematically pricing in fear.
Precisely. And this explains why retail investors are so incredibly susceptible to getting caught on the wrong side of sudden shifts in international news. If the global headlines suggest even a hint of de-escalation or, say, a ceasefire, that geopolitical premium just evaporates.
It's just gone.
Instantly, it vanishes. The massive institutional funds, they start unwinding their positions to lock in their gains. And the retail investors who bought at the very top, the ones chasing that 41% momentum because they saw it trending on social media, they're left holding the bag.
Wow.
So yes, a 10% drop might be completely normal profit taking for a hedge fund. But for a retail trader who bought at $176, it feels like an absolute free fall.
Yeah, okay, that mechanism makes perfect sense. So if the stock price is suddenly tumbling because the narrative is shifting and fear is evaporating, I feel like the logical next step for us is to look under the hood at the underlying business. I mean, does the fundamental foundation of Exxon actually justify any of this panic?
It's the perfect place to look, honestly, because when the narrative gets shaky, you have to look at the ledger.
Right. And let's conversationalize these financials because the sheer scale of this company is staggering. So looking at the trailing 12 months, the income statement shows total revenue of $323.91 billion.
Which is astronomical.
Yeah. I mean, that's essentially the GDP of a mid-sized country just flowing through their income statement.
Mm.
And after all the bills, taxes, and operational costs are paid, they're looking at a pure net income of $28.84 billion. Basic earnings per share sitting at $6.70.
Yeah.
And their balance sheet for the most recent quarter is, well, it's basically a fortress. Total assets of $448.98 billion versus total equity of $259.9 billion.
But the metric that stands out the most on that balance sheet, especially in a high-interest environment like we have now, is the debt.
Oh, exactly. The debt-to-equity ratio is exceptionally low, just 16.78%. And to put that mechanism in perspective for you, it's like someone earning $100,000 a year in salary, but they only have $16,000 in total debt to their name.
Right. It's practically nothing.
Yeah, it's a completely bulletproof foundation.
Yeah.
I mean, you would never worry about that person going bankrupt if they hit a rough patch at work.
That is the exact way to look at it. And if we connect that low debt burden to the broader operational picture, it really explains their massive cash flow situation. Because they aren't drowning in interest payments, they're generating roughly $27.8 billion in free cash flow. Yeah, and that's the actual tangible cash left over after paying for all their operations, their salaries, and their massive capital expenditures, like building new rigs.
But with $27.8 billion in free cash, my immediate fear is always that management gets reckless, right? Like, do they start buying up shiny, overpriced side projects just to stroke their egos, or are they actually returning this money to the people who own the stock?
Oh, they are definitely returning it. Exxon is what the market classifies as a dividend king. So right now they're yielding 2.70%, which translates to $4.12 annualized per share.
Okay.
But the king status isn't about the size of the yield today. It comes from the fact that they have increased their dividend payout every single year for 43 consecutive years.
43 years. I mean, that means they increased the payout through the 2008 financial crisis, through a global pandemic, and through previous oil crashes where crude literally went to zero for a day.
Exactly. And let's unpack why that consistency matters so much right now. Because in a volatile market like the exact one we're experiencing in April 2026, with these geopolitical premiums violently shifting up and down that $27.8 billion in free cash flow, is the engine that guarantees the dividend payout.
It's a safety net.
Exactly. It provides a psychological and mathematical safety net. Long-term investors look at that and say, well, even if the stock price drops 10%, I am getting paid out of a bulletproof cash vault while I wait for the stock to recover.
Right. Okay. So the math there is incredibly strong. But if the vault is completely full of cash, why is the technical stock chart painting a horror story?
Yeah, that's the big question.
Because this is where the massive disconnect happens. The fundamentals look backward and long-term, but the technicals measure the immediate psychology of the market. And right now, the chart is bleeding.
It really is. The fundamental reality and the technical reality are entirely divorced from one another at this exact moment.
Let's break down the technicals then. The daily trend direction is officially listed as a strong sell. The RSI, the Relative Strength Index, is at 43.29. Now, for anyone unfamiliar, RSI measures the speed and change of price movements on a scale of 0 to 100. So at 43, it's drifting out of the neutral zone and leaning heavily toward a sell.
Right.
Then you have the MACD indicator sitting at negative 1.53, which is an active sell signal.
Let's demystify MACD for a second because it sounds intimidating, but the concept is actually pretty intuitive.
Yeah, go ahead.
MACD basically compares short-term momentum to long-term momentum. Think of a marathon runner. They might still be moving forward, which is the stock price itself, but the MACD measures their breathing and heart rate. So right now, at negative 1.53, Exxon is breathing incredibly heavy and slowing down. The underlying momentum driving the runner forward is actively fading.
I really love that analogy.
Right.
And you can physically see that exhaustion in the moving averages, too. Both the 50-day moving average, which sits at $158.17, and the 200-day moving average at $158.43 are hovering above the current price of $151.40.
Yeah, acting as a ceiling.
Right. Those averages act like gravity, When the price is below them, it confirms we are in a medium-term downtrend.
The momentum has clearly shifted from a euphoric bullish phase right into a very heavy bearish phase.
And the key levels reflect that heavy gravity too. Resistance, that ceiling the stock struggles to break through, is sitting directly above us at $155. And that 155 level actually used to be support, by the way.
Always a bad sign when support turns to resistance.
Totally. Then there is more resistance at 166 and way up at the 175 to 176 all-time high zone. Now, below us, the supposed floor is at $146.96 and then down at 137.24. And if it breaks below 140, that means a complete return to pre-crisis levels. All the geopolitical premium gets wiped out entirely.
The order flow data gives us some vital clues as to how aggressive this selling pressure actually is too, because it's not just a slow drift downward.
No, it's violent. I mean, look at April 7th. There was a massive after-hours plunge from 163 straight down to 154.
Right.
And following that, we saw a rising short sale ratio hitting 17.8%. That means nearly 18% of the daily volume is people literally betting the stock will go down. Oh, and insiders, the executives at the company, they sold 11,460 shares recently over the last 90 days. They're now left with just 0.03% total ownership. So, had to play devil's advocate here. Are we putting way too much faith in these technical indicators?
How so? I mean, what makes you say that?
Well, look at the insider selling metric, right? Insiders own practically nothing, just 0.03% of the company. Does them selling 11,000 shares actually mean anything for a corporation worth almost $450 billion?
Yeah.
To me, that sounds like statistical noise. Maybe an executive just needed to buy a new yacht, you know?
Yeah, sure.
And if the business is generating nearly $29 billion in pure net profit, should a long-term investor really care that the marathon runner is breathing heavy on a chart?
It is entirely valid to be skeptical of the technicals in isolation. And you are completely right about the insider selling 11,000 shares for Exxon is literal pocket change.
Right.
It absolutely does not mean the executives think the underlying company is failing. But here's what the technicals do tell us and why you ignore them at your own peril. They reveal the collective footprints of market psychology.
So they're essentially measuring the fear in the room.
Precisely. Right now, the overall broader market sentiment is categorized as fearful. The Fear and Greed Index is sitting at a low score of 35.
Wow, that is low.
Yeah. And when an institutional fund dumps a massive block of shares after hours, pushing the stock violently from 163 down to 154, that leaves a permanent psychological mark on the chart. That creates your resistance. People who bought at 163 are now trapped, and the second the price gets back to 163, they are going to sell just to break even. That is how resistance mechanics work.
And what does this mean for the downside risk? Like, what is the danger for the regular retail investor looking at this setup?
This is exactly where retail traders often get trapped. They look at that strong fundamental balance sheet we just discussed. They see the stock drop to what looks like a solid support level, say, that 146 level, and they try to buy the dip.
Makes sense on paper.
Right, but it's like stepping onto what looks like a solid hardwood floorboard, but it's actually just cheap balsa wood painted to look like oak. You put your financial weight on it at 146, but the institutional selling pressure hasn't actually exhausted itself yet, and the floorboard immediately snaps.
Oh, man.
Yeah, it sends you down to the actual basement at 137. The retail trader is suddenly underwater and stressed, despite buying a fundamentally great company, simply because their timing was driven by fundamental assumptions rather than technical realities.
Okay, well, that brings us perfectly to the great debate happening on Wall Street right now. Because of this massive disconnect, the stellar financials fighting against the terrible technicals analysts are completely divided on the stock's true valuation. Are we looking at a stock that is deeply undervalued, or is this a classic value trap?
The consensus analyst rating perfectly reflects that underlying confusion, too. It's currently sitting at a moderate buy, or outperform, with a pretty lukewarm score of 2.3 out of 5.
Yeah, and the price targets are entirely all over the map. The average target is $159.84. But you have Wells Fargo aggressively high at 185, and then some other firm dragging the low end all the way down to 123.
It's a huge spread.
It is. So let's break down the two sides of this debate, starting with the bears. The bear case argues that Exxon is currently overvalued because the current Price to earnings ratio, the PE, is 22.83. That is drastically higher than its 5-year historical average, which sits around 14.
Right. To explain that mechanism simply, the PE ratio tells you how much you are paying for $1 of the company's earnings. Historically, over the last 5 years, investors were willing to pay $14 for every $1 Exxon earned.
Okay.
But today, you are paying nearly $23 for that exact same dollar of earnings. From a historical perspective, that multiple has expanded, meaning you are paying a massive premium today compared to the recent past.
But then you have the bull case, and they argue it is deeply undervalued. They use what is called a discounted cash flow model, a DCF, and that model suggests a fair value of $242.67 per share.
Wow.
Yeah, that implies the stock is currently sitting at a massive 32% discount.
It's a fascinating split in financial methodology.
It is. It's exactly like buying a house. Imagine one appraiser looks at the property and tells you, hey, you are vastly overpaying. The current asking price is way higher than this neighborhood's 5-year historical average. That's the PE ratio talking. It's looking backward.
Yeah, exactly.
But then a second appraiser comes in, walks the property and says, are you kidding? This asking price is a total spiel. You are getting a 32% discount because there is oil under the backyard, and I am calculating the future earning potential of this land over the next 20 years. That's the DCF model. But how can both of these realities exist at the exact same time?
Because, just like your appraisers, they measure time differently. A PE ratio is heavily anchored to recent history and current tangible earnings. A DCF model attempts to mathematically predict the future.
Okay.
The DCF looks at that $27.8 billion in free cash flow, assumes Exxon management is going to successfully keep growing that cash over the next decade, and then calculates what all that future hypothetical cash is actually worth in today's dollars.
So the 32% discount only actually exists if the future plays out perfectly according to the spreadsheet.
Exactly. And this raises the most important question of the deep dive. What happens if the future is bumpier than expected? That is the literal definition of a value trap. A stock looks incredibly cheap based on projected future cash flows, but if those cash flows fail to materialize because global oil prices drop or major extraction projects get delayed, the math behind the DCF model completely collapses.
It just falls apart.
Yeah. The so-called fair value plummets from 242 right down to reality, and the investor is trapped holding a stock that wasn't actually cheap at all.
Okay, so the math is completely split. The past says it's expensive, the future says it's cheap. What is the tiebreaker here? What actual real-world event is going to force the market's hand to choose a direction? I mean, to figure out which appraiser is right, we have to look at the impending catalysts. Let's weigh the short-term risks against the long-term outlook.
Well, in the short term, specifically over the next few weeks, investors need to expect high volatility. The immediate hurdle staring us in the face is the Q1 earnings report scheduled for April 24, 2026. Analysts are currently expecting an earnings per share of $1.75 on revenue of $85.47 billion.
But there are some serious fundamental short-term risks hanging over that upcoming report.
Yeah.
I mean, the market is looking at an estimated 6% Q1 production hit, specifically because of LNG liquefied natural gas disruptions in Qatar.
Let's explain why Qatar matters so much here.
Yeah, please do.
Exxon has massive investments in Qatar's North Field East expansion, which is one of the largest LNG projects on the planet. When there are logistical or geopolitical bottlenecks moving that gas out of the region, it directly and immediately throttles Exxon's quarterly output. It's a massive choke point.
Wow. Okay. Add to that, refining margins are currently narrowing, which squeezes their profitability on the product they do manage to move. And of course, there is the massive risk we talked about earlier. If there is a sudden Middle East ceasefire, it erases the geopolitical premium overnight.
Yep.
Plus, it is worth noting that Exxon is historically known for having somewhat lumpy quarterly output.
Right. Lumpy meaning their production isn't always a perfectly smooth, predictable line moving up and to the right every single quarter. It can jump around significantly based on routine maintenance schedules at the refineries and the exact timing of when new offshore projects come online.
Okay, so the short term looks incredibly messy. But then look at the long term, the best case recovery scenario for the bulls. They have 10 key global projects slated for successful completion by 2025 that are fully coming online. And they're actively projecting $4 billion in annual synergies from the massive Pioneer Natural Resources acquisition.
And we should clarify what a synergy actually looks like on the ground in that deal. By acquiring Pioneer, Exxon now owns adjacent, contiguous plots of land in the Permian Basin.
Right?
This means they can drill massive, multi-mile horizontal wells without suddenly hitting a neighbor's property line and having to stop. That operational efficiency alone saves them billions in logistics and drilling costs. It is a massive fundamental advantage.
That's huge. And then there is the absolute crown jewel of their portfolio, the massive Guyana Stabroek block. They're targeting production of over 1 million barrels a day from that specific region by late 2026.
The Guyana asset cannot be overstated. It is truly a generational growth driver for them. It is one of the most significant oil discoveries of the last decade, with incredibly low break-even costs.
So with all of this hanging in the balance, I have to ask you to weigh these against each other. We're staring down this upcoming April 24th earnings report. Is this short-term report the domino that finally pushes us down through that fragile floorboard to the 137 basement? Or is the long-term promise of Guyana the spark that breaks us back up through the 155 resistance?
What is fascinating here is that the answer depends almost entirely on which time horizon the market chooses to focus on. If you weigh the short-term weakness, the Qatar LNG disruptions, and the narrowing refining margins against the long-term structural strength of the Pioneer operational synergies and the massive Guyana output, the long-term business is undeniably stronger.
I see the logic there, but let's be real for a second. The market isn't always rational in the short term. Wall Street is incredibly short-sighted.
Exactly. It is highly reactive. If a Middle East ceasefire happens around the exact same time as a lumpy, disappointing earnings report on April 24th, the worst-case continuation lower is highly, highly likely in the immediate future. The technical momentum, the marathon runner's breathing, right, is already pointing down, and the fear index is high.
Yeah.
A drop to test that 137 level would severely test the patience of long-term holders. But if you look past the next 3 months, fundamentally, that $28 billion cash flow engine remains entirely intact.
Okay, let's summarize the journey we've been on today, because there are a lot of moving parts here. We are looking at a financially bulletproof corporation. It is a literal dividend king, generating nearly $28 billion in free cash flow, protected by a tiny 16% debt-to-equity ratio, with incredible long-term growth prospects coming out of the Guyana Basin and the Pioneer acquisition synergies.
Right, but on the flip side of that coin, it's caught in a really nasty, undeniable technical downtrend.
It's fighting fearful market psychology, immense geopolitical uncertainty in the Middle East, and a short-term valuation multiple that feels stretched compared to its own historical averages. I mean, it is the ultimate tug-of-war between strong fundamentals and bleeding technicals.
Which is exactly why it is so important to look at the data from both angles, not just one. You really need the full picture to understand the battlefield.
Definitely. Well, before we go, please remember to like this video and subscribe to our YouTube channel so you never miss a deep dive. And drop down into the comments. We want your feedback. Are you looking at this as a massive 32% discount buy or a dangerous value trap? Let us know.
And as you think about your own strategy, I want to leave you with this final provocative thought to chew on. If a sudden geopolitical ceasefire pulls the rug out from short-term oil prices tomorrow, but massive, highly profitable production from Guyana is looming just over the horizon in late 2026, are retail investors letting the temporary fear of a 10% drop shake them out of a once-in-a-decade 32% discount, or are they smartly stepping out of the way of a classic, devastating value trap?